Hello, and welcome to today's webinar by Exponent Philanthropy. Today, we will be discussing how lean funders can navigate COVID-19 markets and maximize their capacity to make an impact. We are recording this webinar, and it will be made available to you after the program, along with a copy of these slides. Exponent Philanthropy is the country's largest association of funders and the only one dedicated to serving foundations with few or no staff, philanthropic families, and individual donors. Our vibrant network has in common lean operations and a style of philanthropy motivated by personal passion, community needs, and the strong desire for better outcomes. We provide high quality and cost-effective programs, resources, and connections that maximize our members' dollars and time for the benefit of diverse communities and causes. I'm Althea Georgantis, Program Manager at Exponent Philanthropy. I am joining you from Washington, D.C. I first just want to give a quick overview of how we'll be using Zoom today. If you take a look at your controls, I first want to point out the audio settings button. That's where you can adjust your listening options, including the option to call in by phone. Second, I want to highlight the chat function. That's how we'll receive all of your questions today and any comments or contributions you'd like to make. So one point about that is if you want the rest of the participants to see your chat, and ensure that you have enabled the option circled in red here, sent to panelists and attendees. I also want to note that we'll be saving the bulk of Q&A for the second half of the presentation, but that please do enter in your questions as they come up. Before we get started, I want to highlight the ways that Exponent Philanthropy is committed to supporting our community of lean funders during this unprecedented COVID-19 pandemic. We have a webpage with resources for lean funders specifically. We are updating it regularly. We've been hosting live discussions every Friday for the past couple of months for funders to learn from each other and connect during this time. If you've missed any of those, you can view the summaries and recordings of the ones we've held so far on our resources page. And you can tune into our next session tomorrow at 2 p.m. Eastern. In addition to those opportunities to connect directly with other funders, we'll also be hosting webinars and other virtual programs like this one, where you can hear from experts and learn critical information that will help you navigate this crisis as events continue to unfold. We've been regularly asking all of you what you'd like to learn about and basing our plans on your responses. It's why we're doing this webinar today. So please reach out to us if there's something you're struggling with or if you have experiences that you'd like to share. And of course, our online member discussion community is always open for members looking to discuss what's on their minds and has been really active these past few weeks. In furthering our mission of supporting lean funders, we're excited to announce that from now until June 1, the Coleman Foundation in Chicago will match any donations you make to Exponent Philanthropy 1-to-1, meaning you have the opportunity now to double your impact. We hope you'll consider supporting Exponent Philanthropy so we can continue to provide a place for lean funders to connect with answers, experts, and peers during these uncertain times. Visit exponentphilanthropy.org for more information. Today's webinar is presented in partnership with Glenmead, one of the nation's leading investment and wealth management firms, with $40 billion of assets under management for endowments and foundations, high net worth individuals, families, and family offices. Glenmead also provides customized administration, grants management, and advisory services to foundations and other nonprofit organizations. So I'm happy to introduce our two speakers joining us from the Philadelphia area where Glenmead is based. Michael Crow provides investment advice and portfolio management for endowments, foundations, and other not-for-profit organizations. He has a robust understanding of nonprofit investment management and has spent over 25 years in the financial services sector. We're also joined by Hulda Robertson. Hulda is a business development director responsible for cultivating relationships with endowments, foundations, tax-exempt entities, and high net worth individuals and families. And with that, I will pass it over to Hulda and Michael.
Wonderful. Thank you very much, Althea. That was such a warm welcome. And yes, Michael and I each join you from our homes in the greater Philadelphia area too, in these unprecedented times. And as Althea said, Glenmead has been proud to be a very long-term partner with Exponent Philanthropy, and we're thrilled to be joined with so many of our friends within the Exponent family as we all try to navigate these unprecedented times. As she mentioned, Michael and I come from the dedicated foundation and endowment group that serves investments and advisory. We've done a number of these webinars in the past with Exponent, but I will say today feels quite different. We're all connected virtually and in a somewhat more meaningful way, because right now, virtually is the only way we can connect. And while COVID-19 has forced nonprofit organizations in these unprecedented challenges, it's also really been a catalyst for people to come together in a meaningful way. For example, in cities around the country, we are seeing political and business leaders, donors, and foundations of all sizes pool together grants to provide emergency aid for those who need it most. More than ever, smaller nonprofit organizations who need additional support in order to continue to provide for the underserved populations where the effects of COVID-19 have led to new challenges, such as a loss of a job, loss of childcare, and perhaps even the loss of a meal for kids no longer attending school. And hopefully you will not hear my children who are downstairs not attending school today. And in addition to this all hands on deck mentality to support the immediate needs of our most vulnerable communities, our foundation clients are also looking to drive impactful results from their investment portfolios. So while not every organization's mission is unique, we are seeing investment committee members with their fiduciary hats on, wanting to do three main things. First, they want to protect their dollars in their foundations. Second, they want to regain the dollars that they've lost during this recent volatility. And third, they want to grow their dollars. So at the end of the day, with your grants committee hat on, you can be more impactful with your money, with your efforts, now and into the future, to support your many passions and the mission of your foundations. So how do we do this during this very volatile time? Well, as Althea said, we are listening to your questions. We're listening to the Friday Funders calls. We're listening to the entire Exponent community, and you're clamoring for information and guidance. So today we're going to walk through three things. First, we're going to look at big picture data. What happened? What does this look like? Give us the facts and show us what it will look like going forward. Second, we're going to outline what that path forward might look like, and more importantly, what it will mean for your foundations. And finally, we're going to discuss what this means for your foundations and your grant making activity. So as Althea said, please feel free to ask questions throughout, but I think you're going to really enjoy this conversation as we get more and more granular at affecting the questions you have to answer. So Michael, let me turn this conversation over to you.
Thank you very much, Hulda, and good afternoon, everyone. I would like to echo Hulda's gratitude for everyone taking the time to join us today. I know in these unusual circumstances, time can be a precious commodity, so we appreciate you sharing some of yours to hear our thoughts. And at this time, I'll move right into our slide presentation to really make the maximum use of the time available to us. So as we turn to the first slide, what we see here is a chart depicting the movement of the S&P 500 equity index over the past 3 months. On the left-hand side of the chart, you see in early to mid-February, the index hovering at a level just under 3,400, closing at an all-time high on Wednesday, February 29th. This occurred at a time when the economy of the United States was in the 11th straight year of expansion, representing the longest expansionary period on record. This was also occurring as news of coronavirus cases in Asia and Europe were beginning to gain more focus in media reports. As cases within the United States began to be reported, financial markets only then began to take note and price in an economic impact from the virus. As you can see, the move lower in equity markets was sharp and rapid. Just over a month after peaking, the market had fallen 34%. Subsequent to that near-term bottoming, which took place on March 23rd, the market has rallied at approximately 27%. Much of that rebound has been driven by the actions of government and central banks in regards to fiscal and monetary stimulus. As we turn to the next slide, we reiterate the uniqueness of these recent market actions. What is shown here is the length of time in months for the last 10 bear markets to play out, where a bear market is defined as equity prices falling by more than 20%. The move lower in response to the virus resulted in a bear market within 1 month, Even the great financial crisis of 2008 and 2009, shaded in the middle of this page, saw equity prices take almost a year and a half to fall 20%. The next shortest occurrence at 3 months was the stock market crash in December 1987, more commonly referenced as Black Monday. This large move we have seen in equity markets has been characterized by significant levels of volatility. Here we show that through the first 4 months of the year, 2020 is already second only to 2008 in terms of the number of extreme daily moves, where we characterize an extreme daily move as greater than 3%. These elevated levels of volatility is something that we expect to continue for the foreseeable future. One of the factors driving volatility in the equity markets has been the concern in the fixed income and credit markets. Here we show the credit market's reaction to the virus outbreak. What is seen here is that credit spreads, or the amount of risk compensation on both investment grade and high yield corporate debt, spiked higher in March as credit markets seized up, with investors refusing to lend cash to companies. It is also seen here that credit spreads have begun to move lower as equity markets have rallied in response to government efforts. This seizing up of the credit markets was a significant occurrence and will inform our understanding of the Federal Reserve's efforts, which we'll talk about shortly. As we wrap up this section on what has happened, this slide provides good insight and begins to form our outlook. As the title states, not all bear markets are created equal. Since 1880, there have been 20 bear markets. Each one can be placed into one of 3 categories. Clearly, the most recent occurrence, driven by the COVID-19 outbreak, falls into the event-driven category, along with events such as the OPEC oil embargo of the early 1970s. And looking at the general characteristics of these categorizations, we can see event-driven bear markets occur more rapidly. They result in recessions less frequently, although we do believe this time will result in a recession. And the length and depth of which is still to be determined. We also see that the most recent decline at down 34% was relatively in line with the average for these occurrences. Finally, and most importantly, the time to recover, that is how long until the stock market gets back up to its prior peak, is significantly shorter than other bear market scenarios. This is reinforced by the rebound in equity markets seen since they hit their near-term bottom back on March 23rd. These shorter recovery timeframes have been shown to be a result of the fiscal and monetary efforts employed by the government and central bank in response to these one-off shocks. This leads us to the topic of the response of the government and the central bank. Here we show the necessary 3-pillar response to what is, first and foremost, a health crisis. This first pillar involves public health policy. That is, the effort to contain and slow the outbreak and mitigate the impact of future risks through the development of antiviral treatments and a vaccine. Until this can be accomplished, the economy will be unlikely to get back to prior growth levels. Pillars 2 and 3, monetary policy and fiscal stimulus efforts, should be thought of as a bridge that will get us across this period of time until there is a pharmaceutical solution. The length and the expense or ultimate cost of that bridge will be determined by the effectiveness of the public health policy response. The next slide reflects the efforts of the Federal Reserve Bank that took place over the month of March. As the impact of the virus became more significant, much of this effort, specifically many of the lending facilities, are tools that were used during the financial crisis of 2008-2009. The 2 key takeaways from the Federal Reserve's efforts are this. First, the magnitude of their effort. This can be seen in the column to the far right, as they have committed to unlimited quantitative easing. Think of this as purchasing of US Treasury debt, as well as the commitment to provide $2.3 trillion in loans to businesses. This dwarfs the monetary resources put forth during the 2008-2009 crisis. The second point to focus on here is their effort in is the effort on maintaining a supply of credit in the marketplace. This is again seen in the resources made available in both the loan programs and the lending facilities. Normally, the central bank attempts to influence demand for credit by lowering or raising interest rates. What they saw occur in the first week of March with the seizing up of fixed income markets was that a lack of supply of credit was creating a risk of this turning into a financial crisis and not just a health crisis. Their goal then became to maintain efficiently working financial markets. It is through these working financial markets they believe that stimulus checks to individuals and other fiscal measures will most effectively be transmitted or turned into economic growth. This takes us to the federal government's response, which has also been significant. The first two initiatives were aimed at emergency appropriations to state and local governments, as well as money for COVID-19 testing, paid sick leave, and increased unemployment insurance benefits. It was truly the CARES Act component, as the legislation was titled, that provided the significance in regards to the federal government's response. It's $2 trillion of government spending in the form of stimulus checks to households, small business loan programs such as the Paycheck Protection Program, and loans to distressed business sectors within the economy is what has pushed this response into unprecedented territory. A fourth phase quickly followed the CARES Act with an additional $450 billion of spending, largely to provide greater funding to the Paycheck Protection Program. Comparing the US response to the rest of the world in terms of the percentage of gross domestic product, or GDP, we again see the magnitude of the federal government's response as it now stands at 13%. With that background, and having seen what has taken place over the recent past, we'll now start to look at expectation and investments going forward. A well-balanced approach to long-term investing is important. Despite the historically low level of yields, bonds continue to maintain a value in their counterbalancing effect on equities. Here we see in the COVID-19 driven move lower in stocks, bonds provide a protection in a manner consistent with prior historical declines in the market. Having said that, we must also be prepared for an environment where interest rates remain low for an extended period of time. Here we see the yield curve on US Treasury securities with recent rates reflected in the blue line, showing 2-year yields around 20 basis points or 0.2%, while 10-year yields hover around 60 basis points or 0.6%. Both show yields being significantly lower than where they were coming into the year. The brown line the brown line represents that coming into the year. In addition, relative to their averages over the past 20 years, which is shown via the green line, we also see significantly lower rates. With the Federal Reserve's expectations of needing to keep rates at zero for the foreseeable future, markets are pricing in a lower for longer environment for yields on fixed income assets. This leads us to look at expected returns for some broad asset classes. Here we show the projected 10-year returns for cash and fixed income assets in the gray tones, while equity assets are seen in blue. The lighter shaded bars represent the projected returns as of pre-COVID beginning of the year market conditions, while the darker bars show recent levels following the significant moves in markets. While I would emphasize the broad trend of expectations for cash and fixed income assets generally moving lower, driven by the dramatic move lower in rates seen on the previous slide, while equity projections moved higher. Unfortunately, that shift higher in equity projections is not due to an increased growth expectation, but rather it reflects the lower starting point for index values that are the result of recent moves down. The only specific figures I would draw your attention to are the low level of projected returns for the core fixed asset class, which consists largely of US Treasury and investment grade corporate bonds. And also I would point out the US large, which represents the large cap segment of the domestic equity market. Both of these assets are traditionally significant allocations within their respective broader asset classes. The next slide provides insight on an additional dimension of our view on equities. These are 4 technical factors which attempt to measure investor sentiment via market metrics. When these are at elevated fear levels, as all 4 have been of late, they have historically indicated a good return for equities over the subsequent 12-month period. This is reflected in the gray shaded area on the right, where we see a high frequency of positive returns, as well as the magnitude of the average return. As long-term investors, this is certainly not a primary focus of our investment thesis, but it does inform on potential opportunities. While these have been good indicators when reacting to economic or cyclical types of events, as has occurred in the past, there must be caution in the current environment as we are dealing with an inherently unpredictable risk in the virus. That unpredictable nature of the virus leads us to be mindful of 4 potential scenarios in which the economy could unfold going forward. Market analysts have grown to characterize the recovery in terms of the shapes of letters such as V, U, or W, which attempts to reflect how quickly the economy gets back to its pre-COVID trend. Currently, our base case is for a U-shaped recovery, reliant upon the economy opening back up in late summer and gradually recovering through the 4th quarter of this year. The risks to this outlook are skewed to the downside as there have been concerns surfacing over potential localized resurgences of the virus, which would extend the recovery time period. As we continue to be mindful of volatility, as long-term investors, we also need to be mindful of balancing long-term goals against risk tolerance. A properly structured investment policy should have established this base and permit an entity to remain invested to an appropriate degree during such volatility. The chart we are looking at is an interesting way to frame the longer-term penalty of being out of the market. On the left-hand side, we see the annualized return on the S&P 500 index over the last 35 years at 8.7%. We then show the return for those 35 years if an entity had not invested for the best 10 days over that period. An investor would have forgone over 2% of annualized return, earning only 6.5%. Missing the best 1 to 2 days per year, as seen in the 2 bars on the right side, results in returns slightly below cash, or worse yet, negative returns. Certainly enlightening in the context of efforts to make market timing calls. This leads to understanding the need to have investment decisions made with an appropriate reference to investment time horizon. Here we see a table outlining the return statistics upon entering a bear market as we have so recently done. While the likelihood of positive returns goes up for investors due to the fact that the market is at lower valuation, this likelihood is very sensitive to how long one can wait to realize those returns. Markets may not immediately rebound from a bear market, such as the first 6 months, but market returns have historically been positive 100% of the time after 5 years. For investors with longer time horizons, this may prove to be an attractive entry point. I will acknowledge that we have seen many of these gains play out in the rebound seen over the late March and April time periods. Finally, with the effort to reflect our economic and market outlook, we move to this slide, which emphasizes a recognition of the need for diversification, as well as the acceptance of risk to achieve a certain goal. Here we see in 1995, a 7.5% return could be achieved by holding 100% of a portfolio in core bonds or core fixed income. These are predominantly US Treasury and investment grade corporate bonds. You could earn this return while only taking on 6% risk as measured by the standard deviation of returns. Move ahead 10 years to 2005, and you can see that you need to diversify into equity assets and some real estate to achieve that same return. But you have also increased the risk in the portfolio. We see a similar result in looking at these numbers in late 2019, with a greater number of asset classes and an even higher level of risk. We generate these metrics annually toward the end of the year, so while we do not have figures subsequent to the recent market volatility, 2019 figures still convey the general concept of the need for greater diversification and additional risk needing to be taken within portfolio strategies. While that wraps up our market outlook and perspective on investments, we have one more topic to discuss. It is a concept that we have received numerous questions on in recent client meetings. It is framed nicely by the topics that we just covered, and it is a question with which I am sure many of you have been wrestling. That is, in the context of the economic impact of the pandemic and the immensity of the needs seen across the various sectors of nonprofits, can the assets of the organization support an increased level of giving or grant making in the near term? Our perspective on this is to always present our feedback within the context of the organization's investment policy and the responsibility to balance near-term needs with its long-term goals. I'd like to walk you through a tool that we have used to assess the scenario on behalf of some clients. On this slide, we simply map out a sample asset allocation based upon a defined investment policy and reflect the expected returns and volatility on the portfolio over a 20-year time horizon. At the top of the page, we show a traditional 75-25 allocation between equity and fixed income. You see the allocation consists of cash, core fixed income, and equities having allocations across domestic large cap and small cap, as well as international equities. On the right-hand side, under the return risk section, we see the portfolio has an expected return of 7.2% with a standard deviation of 12.8%. We show this as a comparison to our somewhat typical asset allocation for a foundation account seen in the lower half of this page. Here you will see a relatively similar allocation, only it does reflect slightly more diversification across 3 additional asset classes: real estate, absolute return, and commodities. The resulting risk return profile shows a slightly higher expected return at 7.4%, while bearing marginally lower risk at 12.4%. In this allocation and its risk return profile, while these are used as inputs in the analysis on the next slide, the one figure that I would ask you to keep in mind is that that expected return figure of 7.4%. Turning to the next slide, while there is a lot of information on this page, please don't feel overwhelmed, as I will walk you through how to interpret this. This is a Monte Carlo simulation that attempts to provide projected portfolio values based on a multitude of possible outcomes. Specifically, the model runs 1,000 scenarios based upon return assumptions and historical relationships to come to these statistical conclusions. At the top of the page, we see the model inputs. We see an initial portfolio value of $10 million, an annual payout of 5%, as well as the dollar amount of the first year payout. Inputs that are not displayed are the rate of expected return, that's 7.4% from the allocation on the prior page, as well as an assumed rate of inflation. In this case, we're using 2% over the next 20 years. The graph at the top simply reflects the various outcomes. I have seen some versions of this which show a line for every scenario in different shades of gray or black. The resulting graph looks like a bowl of spaghetti as it plots the path of growth for each simulated scenario. We choose to show these outcomes in terms of shaded regions, which reflect the probability of those potential outcomes. As an example, the tannish orange section at the top of the page, at the top and the bottom of the graph, represents the 1st and 99th percentile of occurrences. In other words, only 1% of the possible outcomes resulted in the portfolio ending the 20-year period with a value between $40 and $50 million, which is the 99th percentile of outcomes. While conversely, there is a 1% probability of the portfolio having an ending value of approximately $4 to $5 million. That is that tannish orange at the bottom of the graph. This represents the 1st percentile of outcomes. I would draw your attention to the light green shaded area, the 25th to 75th percentile, which represents the most likely outcomes resulting in a portfolio value between 10.8 and $24.5 million. For greater clarity, we only display 2 individual paths as shown by the red and blue lines. I'll first speak to the red line labeled inflation. This can be interpreted as the growth of the portfolio value if the return on the portfolio net of the 5% annual payout equates to inflation. Based upon our inflation assumption, this equates to an annualized return of approximately 7%. What this tells us is that with an ending value of $14.9 million, 20 years from now, the 5% annual payout will have the same impact. That is the same purchasing power as a 5% distribution today. We like to think of this as the baseline need for the growth of foundation accounts. I want to quickly draw your attention to the table at the very bottom of the page, specifically on the shaded column labeled 2040. Here we see in the bottom row a value of 58%. This represents the percentage of the 1,000 simulations that resulted in an ending portfolio market value greater than that inflation value of 14.9 million. In other words, with these assumptions, 58% of the time, the portfolio will have greater purchasing power relative today with its 5% payout. While this 58% might feel like a low outcome, this is dictated by the historically low expected returns on most asset classes. Certainly, this probability could be somewhat increased by moves such as shifting an asset allocation to generate a greater expected return, along with what would likely be greater risk. or by reducing the payout rate for those entities that have that flexibility. But any of these options would have to be done within the constraints of an organization's guidelines. The blue line, which I want to point out, is labeled the median outcome. This is simply the outcome around which half of the scenarios result in a larger ending portfolio value and half result in a lower ending portfolio value. This can sometimes be referred to as the expected outcome. In this scenario, that median outcome results in a port value of $16.9 million, or $2 million above that inflation baseline. That is not surprising, as the expected return that we used to model this was 7.4% versus a combined portfolio payout and inflation rate of 7%. The final number I would point out is in the line directly below the graph. Here we see the total amount of payouts over the course of the 20-year period is $12.37 million. Before we turn to the next slide, I want us all to attempt to remember just three figures. And those three figures that I would like to make sure we all have a mindset on is the ending portfolio value of $16.9 million, the 58% probability of having an outcome greater than the inflation rate. And I will follow up there. We just had a question submitted. Is there a Monte Carlo assumption to changing the spending rate at some point in the next 20 to 30 years? Yes, that's actually what our next slide will reflect. So I appreciate that thought. So the three numbers that we really want to focus on here and take with us as we move on to the next slide is the $16.9 million ending median market value, the 58% probability of returns surpassing inflation, and the total payout figure of $12.37 million. As we turn to the next slide, you will see what looks to be a very similar chart. And it really is, with the exception of one variable that has been changed. In this scenario, we ran that same Monte Carlo simulation with the same assumptions, but only changing the variable as it is outlined in the top labeling of the graph. Here we see projected portfolio values net of 5% long-term annual spending rate, with the exception that we're going to increase our spending rate up to 6% over the next 3 years. So a marginal increase of 1% over the next 3 years. And since I've already walked through the meaning of all this, I'll really draw your attention to those main three numbers that we were talking about before. Here we see that in the median case, the ending portfolio market value results in a value of 16.3 million. And we do see that the probability of outpacing growth of the portfolio outpacing inflation sits marginally lower at 57% as compared to 58%. The third figure that we reflect here is the total payout over the 20 years. Now remember, we did accelerate some of the increased payouts in these first 3 years. What you see here is over the 20 years, we have $12.55 million in payouts. This compares to that $12.37 million in our base case scenario of just remaining steady at a 5% payout. So over the course of 20 years, you would pay out an additional $180,000, largely front-loaded in those first 3 years. So at that point, the question becomes, okay, we're providing additional benefits in this early part of the payout timeframe. We then have a market value that is about 600,000 or 0.6 million lower than we would in the base case scenario. And this is how we really like to present to clients to frame that decision of balancing those near-term needs with the long-term gains. So we just had a follow-up question. So yes, in this second scenario where after the first 3 years, spending is taken back from that 6% to our long-term 5% typical threshold as we saw in the base case. So years 4 through 20 in this scenario would have a 5% payout. So really, this is the way we frame things to provide that opportunity for investment committees and foundation boards to really frame the context of the decisions that they might be facing. Do you want to end up with a lower overall portfolio value, possibly at the end of 20 years, versus providing a greater level of benefit, certainly in the first 3 years, and to a lesser degree over the course of the entire 20 years? And with this, I will wrap up our presentation, and we'll be more than happy to take follow-up calls or follow-up questions, excuse me. But right now I'm going to pass it on to Hulda with the final few steps that we recommend for attendees to move forward with.
Great. And just to follow up on that last conversation, I know there's been a lot of questions before we met today, and probably now that you are all thinking about this and looking at all the numbers on those past two charts. What we're really here to do is to run these scenarios and do the analysis for you in order to give you the information to then make decisions. We have foundations coming to us to say, what if we double, triple, 1 year, 2 year, 3 years? The number of scenarios is really endless. Some foundations, whether it is these times or it is prior to this, for a number of reasons, consider the idea of sunsetting and really focusing their foundation's mission over a series of just a couple of years. Others, the majority of foundations, they do want to exist into perpetuity. So looking at these Monte Carlo scenarios really provides good value to say, what do the values look like over time, both of the underlying foundation investment portfolio and with the grants management hat on, what do the dollars going out look like? How do they change over time? And what type of commitments and multi-year commitments do you want to make? Again, robust conversations both at the investment committee level and at the grants management level. But as we wanted to give you some thoughts on what you can take back and what you can do with your investment committees, some of the things that we have come up with is really to think about what the market volatility has done, how you and your investment advisor are going back to some of your models and your analysis to say what has changed, how is your portfolio positioned now, and what do you need to do to capture both the current investment opportunities, mitigate those risks now, and really watch, as Michael described, some of that alphabet soup, the U recovery, the V recovery, the W recovery, and any possible combinations of maybe WWW recoveries as we've tossed around some of our investment conversations internally. Secondly, very importantly to you, is what type of flexibility do you have within your portfolio and the liquidity you have in terms of the types of investments that you have? And do you have the ability to increase your grant making in these times, and what will that look like? Thirdly, with the recent volatility, are you still on track to meet those long-term objectives? Again, many of you, probably most of you, have a lifestyle or a lifespan of into perpetuity. And the reason why many analyses show that desire to have 7.5% return, that represents the 5% of giving that you will have, plus some type of inflation and fees captured in there. So 5 plus 2 plus 0.5%, that's where we come up with that 7.5% as sort of a universal bogey or goal for everyone to have, regardless of what the market activity is for a calendar year or any rolling period. And finally, when you look at your investment committee and how your foundations are run, a lot of people are really taking this time to look internally and understand how they are positioned, how they are making decisions, both with their fiduciary investment committee hat on, and whether this recent volatility has changed that. Many of you have gone through different types of transitions with the people involved in making those decisions and have looked at different strategies, such as, are you run as a self-managed investment committee? Do you have the help of a consultant, or are you working with an investment manager or something called outsourced chief investment officer? As people transition, those styles or strategies often change, and we have seen a number of foundations, given this recent market volatility, them wanting to look introspectively to potentially change how they are making decisions. So those were some of the thoughts that we came up with to have you go back to look at what you are doing now, how you can adapt going forward, and do you have the tools internally and how to ask good questions of those you are partnering with. Althea, did you want to turn this over to the group for some questions? I know we had some questions before this webinar started.
Yeah, so if people want to open the chat window, that is the best place to ask questions at this stage. We'll just give it a minute to let people type any questions that they might have.
Okay, well, while you are all typing some questions in, Michael, I had gathered a couple of questions of folks before this webinar. You had mentioned, and some of the folks in the call had talked about different types of investment impact. And people were asking the question about socially responsible impact or investing or impact investing. And with regards to the alternatives for the portfolio to make an impact, given the current circumstances, such as socially responsible and clean energy investing, what are some of the opportunities that you see portfolios using?
It's an excellent question, and it's we've been engaged with an endowment and foundation clients in regards to what we broadly refer to as sustainable and impact investing for 5 years and greater. We have clients who have initiated investment policies that seek to align with their values to varying degrees and with a multitude of focal points. We have also seen an increased level of questions from our clients regarding strategies and performance of those ESG-based strategies over the past month or so in response to COVID. So since this form of investing has so many flavors as it looks to satisfy divergent goals and initiatives, we typically do not include slides on the topic in a presentation discussing the broad economic and market environment. Having said that, we have seen data coming out of the first quarter of this year that's very constructive for these various forms of investing. ESG tilted indices had lower downside volatility than traditional indices during March. And sustainable ETFs had record inflows during the first quarter, a strong indicator of investor interest. And actually, if someone wants additional information, our impact investing team recently put out a brief 4-minute webcast in written piece in which Mark Hayes, our Director of Sustainable and Impact Investing, discusses these recent developments around the COVID-19 outbreak. He will we'll certainly include this link to the presentation in the follow-up materials that Althea will be, and the Exponent team will be sending out.
That's great. And I know just from reading through a number of the Friday Funders commentary, the idea of SRI, ESG, PRI, MRI, they're all out there. If they have not talked about it in the past, as we know, a lot of foundations, this is on their radar screen or they are investing. These times are bringing people together and around the table in an additional way. So they're looking for opportunities to learn and potentially take that step forward. So there are a lot of good resources through Exponent, and certainly we can add to that. Michael, changing topics a little bit, getting back down into some of the data you shared with us, specifically about government spending. There's been a lot of government spending there. I remember seeing all the columns, and the word trillion was tossed around there a couple of times. And I know on the table is an additional $3 trillion worth of spending. What type of impact on investment returns do you see going forward, recognizing this significant level of government spending? And how do you think that there will be efforts to support the economy?
Certainly. It's a very pertinent question because there's a very strong debate where you fall in terms of your economic philosophy. And it actually, there's two distinct issues that I'll try to address on this. First is that fiscal stimulus on the part of Congress and the administration. It will certainly increase the government's need to issue more debt. This could result in pushing interest rates higher. Just this week, we have actually gotten through the first round of elevated U.S. Treasury debt auctions. And we've seen little impact to rates moving higher. However, there are mitigating factors in the short to intermediate term that will likely keep U.S. domestic interest rates relatively low. One of those being the desire of the Federal Reserve to provide that quantitative easing and their promise to buy an unlimited amount of U.S. Treasury debt in order to keep those rates low. The second aspect is if you look at U.S. Along the lines of the U.S. dollar is perceived as kind of the world's currency. and the value of dollar-denominated assets has only grown over this recent crisis, as it's obviously affected other regions of the globe. And what you're seeing here is when you look at yields within other high-quality countries, such as Japan or Germany, and you look at their 5 and 10-year yields that are not only negative, but actually in some cases, I'm sorry, not only zero, but in some cases negative, it makes U.S. Treasury yields more attractive. So you're creating that demand over the near term from foreign buyers that are interested in buying this just from an absolute yield advantage basis relative to their domestic countries. So those are two short-term mitigating factors. On the longer-term basis, if we continue to see supply of treasuries move higher, it's inevitable that interest rates will rise. Rising interest rates will certainly, interest is a significant expense line in corporate entities' budgets or financial statements, I should say. So that will certainly be a drag on corporate profitability, corporate earnings, and could also, in the long term, hinder stock or equity or gains in the equity market.
Michael, we have another question. Thank you very much for that.
Mm-hmm.
Now, we have another question similar to this and connected. Getting back to your alphabet soup, your
Yes.
V, your U, your W, and any combination. We had a question here, not to say that you or we have a crystal ball, but are there percentages that you are attaching to those V, U, and W scenarios of what might be the most likely scenarios and paths forward?
Right. With those 4 scenarios that I showed in the slide, we do not actually apply percentages to the various outcomes or scenarios. Right now, our base case, and I hopefully I was clear on this, but our base case is for a kind of a U-shaped recovery where we see the economy get more fully open, as I said, in the late summer. And then slowly over the course of the final quarter of this calendar year 2020, you start to see economic growth move back to trend pre-COVID. I think as I said, I think I alluded to there being some downside risk to that. So you could start to see that recovery if we do see localized resurgence of the virus. You could see that recovery pushed out more into the first quarter or first half of 2021. But unfortunately, we do not have percentages applied to each of those scenarios.
Yeah, and I'll add to that, as you might imagine, Michael and the entire investment-wide team, in addition to the slides we shared with you today, there are countless other data-heavy slides, including a lot of other alphabet soup scenarios going forward. And I think we're all in agreement that we will see more cases going forward. It's just a matter of when and how many and how our government, our economy, and how we as people will react to that. So what that will do to see which scenario will be there. In addition, Michael discussed about this type of setback as being an event-driven setback compared to the cyclical setback. I've also heard, in the early stages that while we are considering this to be an event-driven setback, that it might be paired off as we come into a recovery with some type of a cyclical recession.
That is correct.
Well, Michael, to give you a little pause here, I wanted to answer 2 questions that came up that were they're connected to the conversation today, but stepped away from the dedicated investments. And that had to do with, as investment committees and foundations look introspectively about how they are operating today, what type of information they are getting, and if they are noticing a change or want to make a change, how do they go about doing that? What are the best practices? And I know we've shared in the past about how investment committees can first understand how they are set up, second, understand what their goals are going forward, and really understanding what the different type of scenarios are and what is possible out there. Because if you've looked at the sort of the partnership landscape in the last 10 years, it has evolved, and there are a number of different types of partnerships you can strike up. So in addition to some of the resources we've talked about today on what has happened and in the investment portfolio and what that might mean for you if you were to change your grant making. We'll also include, as you look at your investment committee itself, if you wanted to make a change, what are some best practices to go through that, as they call it, the RFP process, the request for proposal to potentially change your structure. And secondly, I wanted, there were a couple of questions to say, on really with the grant making hat on, are people looking at changing their grant making processes? Are they looking to give more, ask fewer questions, ask different questions? What does that scenario look like? And I would say we are seeing a lot of those questions. We are guiding people to the answers that feel right to them. And we'll also provide, in addition to Exponent's resources, resources that can help walk through that on a national level, and then that may be more connected to you on a regional focus. So no shortage of opportunities and best practices that feel right to you out there on the grant making side also.
Yeah, and if I could add to that, Hulda, one of the things is I saw that question pop up, I kind of thought how could I respond to that? And I draw a correlation with our investment philosophy. And one of the things that we stick to is during times of volatility and uncertainty in the investment markets, we adhere to sticking to our process being those things that we do regularly and routinely in order to maintain the maximum long-term maximize the long-term goals and outlook. And I think there might be a good correlation there that yes, and I think we frame the actual numbers in terms of the investments and the payouts. That's a decision that you could still make, but in terms of where you focus, or are there certain areas of charities, of the charitable sector that could use greater benefit? I would draw the correlation of sticking to your traditional process, because I think ultimately if you do that and you're making sound choices within that process, that will optimize your ultimate impact and goal in meeting your goals.
Well, and as Exponent always does, we invite you to ask more questions, follow up with Althea, follow up with any resources at Exponent. Please feel free to reach out to Michael or me directly. We'd be happy to start a conversation with you. But we thank you all very much for your time today. You are doing amazingly good work in your communities, near and far. We love being part of the Exponent family, and we very much look forward to seeing you, whether it's virtually or in person. Hopefully in person comes sooner rather than later. But please be well, stay safe, and thank you for your time today.
Thank you so much, Hulda and Michael, for your presentation. Yes, and I just want to remind everyone that this conversation is ongoing. A lot of folks are learning in this time of volatility that maybe their processes weren't so great in the first place in terms of grant making. So it's possible that a lot of our members that we're hearing from are reevaluating and taking the time and the opportunity to rethink the way they do things. So yes, please join us for our live discussions and more conversations to come. And thank you to Glenn Mead, a longtime partner and friend, for joining us. Another just quick reminder to join us on social media. We're making posts every day. And that is the end of the webinar. Please do click and fill out our response survey just to help us continue to improve our programming. And thank you everyone for joining.
Thank you.